So this has all been a liquidity area in the market. This area here, all liquidity, been taken, pushed the market down. Today, I'm going to show you exactly how I use liquidity in my trading. So you may well use liquidity already yourself, and it may well be different to the way I use it. But the idea of this channel is for me to share with you exactly how I do my own trading so you understand better the way I'm looking at the markets. So when we're looking for liquidity, the way I use liquidity in the markets is a few different ways. But one of the main ways we can look at liquidity is when we see the market creating these moves in a trending pattern, and then you see the market drop down and then continue up. You may be looking at this thinking, well, why did the market do this? We've been in a nice trending pattern and we broke to the downside. Now, many will be looking at this as a break of structure, perhaps. Okay, and a continuation back to the downside. They'll be looking at a swing point here in the market with a trend line breakout, perhaps looking for a pullback, and then they'll be looking perhaps for the market to pull back here, back to this trend line, and a continuation back down. Now, if that's how you look at trading already, perhaps it may well be how you're looking at trading. I don't know. This, in fact, is how many traders will trade. But what I see here is an area of liquidity. This is a trading range to the upside. And once we see the market gets this swing low, there is an area of liquidity here. Why? If you're taking a trade, let's just go through something. Let's say we had a big area here of demand. And you saw an entry here on a lower time frame or even off this time frame, whichever it is, and you've taken a trade up and you're holding this trade. You took some profits of this previous high. You're holding this trade. Where have you placed your stop? Well, 99 out of 100 times, most traders are going to place their stops below that swing low when they've taken their entry. Some traders may well put their stop down here, understanding that this can be manipulated and taken. Why? Because this is an area of liquidity where we're going to see the markets push down to take this liquidity, basically taking those stops, and then we can see a reversal. Now that's done deliberately to fool the market, to push the market higher. Let's go through an actual example of this. Whoops, let's do that again. Let's go through an example on the chart where we can see this. There's a few times you're going to see this happen on a chart here. First, let's look at this area here on the chart. So we can see and identify the markets made this lower high. Okay, we broke this structure here, lower low, and we pulled back and we wicked through, okay, here, this high, continued down, made a higher low, and then we pushed up again, and then we wicked through this time instead of closing through and closing back through, and then we continued down. So there is your liquidity. Let me show you why. When we see the market come back up here, we're coming back into an area here of supply. It's, there's not a bad trade. Honestly, it's a good trade. But most people will be looking for the market to do what? To most probably take this low. That would be that target out of this area. Look what happened. We made this high and we pushed up, this high low, should I say, and we pushed up to take this high. Look what happened down here. What do you see? Let's go closer in. What do we see here? We see the market from this low, pushing up, pulling back, okay, and then pushing back to the high. What happened here? Okay, so we had one. Okay, the market broke the trend line. Perhaps you're looking for a sell here now. And we went up and we took out this area. This is an area of liquidity. Anybody who's bought up here and perhaps hasn't even seen this area for a sell, they have basically now taken a trade, okay, left their stop below this low. What happened? We come back and they're stopped out. This gave the market fuel to push the market higher. Now, if you was looking for a sell here out of this area, let's say, let's remove this trend line. What else has happened? Well, the market, let's remove this again. We go through again. We can see the market pushes down, pulls back, push down, pulls back lower, and failed to continue down and has come back, and then we dropped off. So what we can see and identify here is the market's making the lower highs. Potentially, you may have sold out of this area, targeting this low, failed to get there. Stops were taken here. The market's pushed back up, took these highs. Stops were taken here with people who put their stop above this high or even above this high, and they've sold down here. So this has all been a liquidity area in the market. This area here, all liquidity, been taken, pushed the market down. Now, you're probably thinking, is there a way to capture this trade? Yes, there is. There's a great way to capture these types of trades. Now, in fact, I call this a banker's pattern here. And we can see the market drops to the downside. We continue down here, and we can see the same thing happens again. So what does the market do? We push down here, okay? Pull back, continue lower. We then pull back here, failed to go lower, and we continue back up. And then we've dropped back off. So let's look at this again. What's happened? Well, the market is basically swept through this high. What is above this high? What has everybody just done at this high? Well, we have, grab this, an area here probably of potential supply on a drop-based drop area. Markets pulled back, took out this high here, and then we continue down. So even here, okay, area of liquidity. People sold down here. And the market's gone back deeper into this area of supply. Deeper, took out these highs and liquidity. There was stops, pushed the market lower. So there was the area. Then we've pulled all the way back up here again into this larger area of supply. And if we take it from here even, and we've bounced out of the supply, continued down. But again, we had to take this liquidity above this high because that's where the stops hit. And then we continue lower. So you can see how the liquidity will come at these areas. Now, when you are actually using the combination of liquidity with like supply and demand, you're going to have that edge in the market. Now, supply and demand is the way I trade, and I use with supply and demand imbalances with liquidity. That is how I trade. I'm not sure how you trade. Perhaps leave a comment and let me know below this video how you actually trade, what you use, and the results you're getting. So if we continue down here, we can see many times we're going to see these areas being taken here even. Okay, we have here an area of imbalance. The market pushes through this area, this high, takes any stops anyone perhaps was sold here on a smaller time frame. Personally, I would have been selling there, but we break out. Okay, we continue down. And again, we can see this all over the chart. Stops above here, push the market, come back, take them, push the market back down again. And even right now, we do have this push through this high. Yes, there is stops here again, and we could see another push back down. But we are also within a larger range, okay, from this move to the downside. So we may want to see the market push up higher. And then we have a different type of liquidity. And we have this area of liquidity. What I see here is some equal highs left over with an area of imbalance above. Now that's something completely different, but this area of imbalance here will need to be filled at some point. And we can see these areas of liquidity left below these zones of imbalances and this area of supply, okay, where we can see them be taken. So we have liquidity above these highs, and we have some equal highs, which creates liquidity when we have like an area of imbalance or supply above, and the opposite when we're looking at demand. So at the moment, if we're looking at this, let's say the market falls back down, we're still looking for buying. Where would we be looking for that liquidity? This low. We'd be looking for the market to potentially perhaps want to come down, take this low, then push back up to take this area of liquidity. That's how you look for these trades. Let's look at this push down here. What did the market do? Okay, we had this swing high where people would have sold. We pushed through that high. Now this is when news is coming out, and many people just looking at price, not understanding why. This is a high of liquidity. The market's pushed up, but before that, before it could push up, see this low here? See that one little low into this area of imbalance? Had to push through that low where we had buyers. Took out the stops, boom, pushed the market up. That's all the market does. They take liquidity on all sides. This low here in the market, left over, higher low, that's an area of liquidity. At some point, that will want to be taken. Now, let me just show you again here. Do you see a pattern? Let me show you again. Some little equal lows. Do you see a pattern? Let me show you one more time. You see those higher lows on the pullback. There's a pullback, pullback, pullback. That's a pullback. Even this bit is. So where's price going to go? That takes out the area of liquidity. Nice drop down. Area of liquidity. Nice drop down. Area of liquidity. Nice drop down. Area of liquidity. So what we're looking for a powerful drop down again. The continuation to take out the area of liquidity. So there you've seen a few different ways now I look at liquidity. We look at the swing highs to be taken as liquidity. We're looking at these areas where we have equal lows. They're not equal in when I say like equal exactly the same price. No, they don't have to be. Okay, they are areas of liquidity left over the lows where the market's taken it. We can look back and you'll see this over and over. Look here, they are equal lows this time. Just here in the market. Area of liquidity. Market takes it out. Again here. This is the pattern I'm trying to show you. Liquidity. Market takes it out. So you've seen those two areas now, how I look at liquidity. And that's the way I would look and use liquidity to help with your trading, only to combine it with supply and demand. Okay. That's how I trade, and that's how you combine it with supply and demand and everything else. Once you understand what liquidity is, where it sits, it's going to help you when you're taking trades. If you're selling up here, you know you're going to take out this liquidity. That's your target. Even if you sold on this candlestick, that's my target. That's how I'm using it. Now, let's say you took a buy here. Where would you be targeting? Well, you're going to be targeting the high because that's the high of liquidity. That's where you expect the market to want to go. And if you were selling here, let's say, where would you sell? Well, you'd either be selling at this low I've just marked or this low, because they are areas where liquidity would sit. In fact, not liquidity. Let's have a sweep. It's not really a sweep push through. That would have been an area of liquidity. This is an area of liquidity. This is a main area. So yeah, you may well thought we could have sold here to this low. But at that point, this was news, not a point where I would be trading. And in fact, you can see the reversal. So you may have been stuck in here. But even if I'd have sold here, I would have got out here. Because that's my first area of liquidity in the market, this swing low. Not this one. So if I'm selling here, that is my target because there's nothing there to stop me. Okay, if I'm selling, well, on this move, if you found a move up here to sell, there's my first area of liquidity. These equal lows. This is the swing low, okay, of liquidity. So I hope this has helped you to understand the way I look at liquidity in the markets, and perhaps you may be able to use that in your own trading.